Hey there, Steve Rubis, the Fix-It IRO for Rafficchio Investor Relations. Today we want to talk about how less does not equal more in investor relations. And what we're referring to is the clarion call issued by Warren Buffett and Jamie Dimon last week for public companies to end quarterly earnings forecasts. We think that this is the wrong approach, the wrong advice, but we recognize that management teams everywhere are likely jumping for joy over this clarion call. The C-suite really needs to resist the urge to follow this viewpoint. We think it's, again, not good. And the problem is most IR programs fail to provide the necessary or requisite information to forego quarterly earnings forecasts. So as long as sell-side research has existed, management teams have eschewed the process of quarterly earnings forecasts. We get it. It's a pain in the butt. But the primary complaint here revolves around the idea that quarterly earnings forecasts drive short-term thinking and inject volatility into share price. Well, you have to remember that a series of short-term thoughts or short-term events creates a long-term event or long-term thought. So to say that short-term thinking is wrong is just, I don't think, really gets at the heart of the issue that we're talking about here. And really, the real problem, I think, at issue here is management teams owning their decision-making and in conjunction with investor relations, really convincing the street that you're making the optimal day-to-day decisions to run your business. And so instead of retreating and providing less information, meaning eliminating quarterly forecasts, really the company should be looking at optimizing the IR program and looking at, are we providing enough information or should we be providing more information? And really, the company needs to make sure that it's providing the necessary investor materials to make its company analyzable. Do I have an investor deck that educates investors? Is my earnings call must-see TV? Am I hitting on the right golden metrics to get people engaged? Do I have an earnings deck that shows my golden metrics change over time? Do I have an earnings release that provides more than a bare bones or simple summary cash flow statement? Am I providing a supplement of key schedules to show what my complex capital stack looks like? And am I going on the road to conferences and NDRs to engage investors actively to get them to buy my stock? If you're not doing these things and you remove quarterly profit forecasts, you're only asking for more trouble. You're not solving any problems here. And really, the second part of this is management needs to own its decision making. How many times do we come across a company or our colleagues are like, what will the investors say? What will the board say? And what do I say? Who cares? Who cares what they're going to say? It's our job as investor relations and C-suite executives to convince those constituents that you're making the optimal day-to-day decision to run the company. Beyond that, if you're an executive, you need to listen to what investors are signaling to you. You can't take offense to criticism or pushback in investor meetings. Use these as great pieces of feedback to further refine how you can convince people that your messaging is right, or adjust your decision making to incorporate some of these ideas that you're hearing. And really, I think we need to hit on the idea of the red flag around removing quarterly profit forecasts. And when I was a sell-side analyst, whenever a company went from, say, quarterly guidance to providing only annual guidance, it was a clear sign of a red flag. It meant that either the corporation itself was not a well-seasoned public company, meaning either someone in the executive suite or someone below them did not have the capability to execute correctly, or at the worst, the C-suite is trying to remove itself from any sort of public scrutiny. If you don't want any scrutiny, why are you a public company? I mean, that's part and parcel of the process, this debate that investors are going to question whether you're making the right decisions. That's why you and IR need to convince the investor that you are making the right decisions. So, really, the idea here is, remember, less is not more. You need to take into account feedback from investors to help you convince them that you're making the right decisions. And if you remove quarterly profit guidance, you're only shooting yourself in the foot. And so with that, I'm going to do a little Weird Al Yankovic here using Ludacris. And What's Your Fantasy, I think, applies to this situation. So I want to analyze you from the top to the bottom line, and I want to move from revenues down to the EBITDA. Then I want to see free cash flow that's so strong I'll buy your stock for anything. but I gotta know what's your earnings gonna be. Hey, if I don't know what your earnings forecast is, I'm not going to buy the stock because I can't build a model and I can't analyze your company. So with that, feel free to reach out. We'd love to interact with you at Rufficio IR. If we work with you, we think your stock is worth more money. Thanks.